Imagine having like a crystal ball for the market's biggest players, cutting through all the noise to get straight to the real insights. Well, that's pretty much what we're going to try and do today.
Okay.
We're taking a deep dive into Teledyne Technologies' second quarter 2025 earnings. We've got the earnings call transcript, the press release.
Yeah, the raw materials. And our mission today really is to unpack the big financial highlights, sure, but also explore the strategic moves this tech giant is making.
Right. And see what it tells us about the wider market, especially in those high-growth areas they operate in.
Exactly. We'll hit the big numbers, definitely, but also, zoom in on some of the fascinating details. What makes Teledyne tick?
Okay, so let's kick things off. The big picture. A record-breaking quarter for them.
Huge quarter. Record sales, what was it? $1,513.7 million.
Yeah, just over $1.5 billion, and that's up 10.2% from last year.
Which is solid growth. And what's interesting is how balanced it was, split almost 50-50 between their organic growth and recent acquisitions.
That's a really key point. And the organic growth wasn't just in one place, was it?
No, that's what really stands out. Organic sales growth in every single segment. That tells you something about the broad-based strength they've got right now.
Really does. Suggests their core stuff is working across the board, not just relying on one hot sector.
Right. Resilience. And the bottom line looked good too. Non-GAAP earnings per share that's, taking out some of the one-off items, up 13.5% year over year.
Hitting a record for Q2, I think it was $5.20 a share.
That's the number. And another crucial thing they mentioned, orders exceeded sales again.
The seventh quarter in a row.
7 consecutive quarter, yeah. That book-to-bill ratio consistently over 1.0, it just signals really strong future demand, a healthy pipeline.
Absolutely. Can't argue with that.
Right.
So drilling down a bit, where were the sort of strategic sweet spots driving this?
Well, energy and defense were definitely standout performers. And if you look at what's driving that, it's things like unmanned systems, both air and subsea space sensors are big. Increased NATO spending is certainly helping.
That makes sense.
And also, offshore energy production is seeing a resurgence. Teledyne plays right into those trends.
And it wasn't just the big, long-cycle stuff either, right? Even their shorter-cycle businesses did well.
Yeah, that was notable. Things like environmental instruments, test, and measurement gear. They saw healthy mid-single-digit increases, best growth they'd seen in a few years there.
And digital imaging, too. You mentioned growth across all segments.
Yep.
Organic growth there was the strongest in 3 years.
Correct. And that was mostly driven by Teledyne FLIR. Their defense and industrial businesses under FLIR had a really strong quarter.
Okay, so let's really break down these segments then. Starting with digital imaging, since you just mentioned it. Sales up 4.3%. Best growth in 3 years.
Yeah, and as I said, Teledyne FLIR was the engine there. Huge contribution.
What specifically within FLIR?
Mostly strong international defense sales, complete unmanned air systems, the actual drones, and also selling the infrared components, the sensors and subsystems, to the broader unmanned market, not just for their own drones.
Ah, interesting. Playing both sides of that market, essentially.
Exactly. And the bookings looked good, too. You mentioned the overall book-to-bill was above 1.
Yeah, 1.1 for digital imaging overall.
Right. And even stronger for industrial and scientific vision systems within that 1.2 times book-to-bill. So demand looks solid there.
Now, there was a slight dip in the non-GAAP operating margin, though.
There was, yeah. But they explained that. It was due to higher severance costs from some streamlining efforts. And importantly, they chose not to exclude those costs from their non-GAAP figures.
Which is, pretty transparent. Shows the actual operational hit.
Right. Okay, moving to instrumentation. Sales surged there, up 10.2%.
Wow, okay. What's the breakdown?
Well, marine instruments were a big piece,
Yep.
up 16%.
16%.
Yeah, fueled by offshore energy, like we mentioned, but also critical subsea defense sales. They specifically called out things like subsea unmanned vehicles and the interconnect business for submarines.
Like the Virginia and Columbia class subs. So very high-tech strategic stuff.
Exactly. Shows that geopolitical relevance.
Yeah.
Then you had environmental instruments up 5.6%, mostly process gas safety, emissions monitoring.
Standard industrial demand, maybe?
Kind of, yeah. And electronic test and measurement, T&M, grew 5.5%. Strong sales in things like oscilloscopes, protocol analyzers.
Okay, the tools for high-speed tech.
Precisely. Stuff that supports high-speed applications, AI network comms like PCI Express. It benefits directly from all that increased data traffic and storage we're seeing everywhere.
Gotcha. And margins look good in instrumentation.
Very good. Operating margin jumped 149 basis points. That's nearly 1.5%, up to 27.6% GAAP, 28.5% non-GAAP. That's
Yeah.
healthy profitability.
Oh, impressive. Then we get to Aerospace and Defense Electronics. A huge jump here, sales up 36.2%.
Yeah, massive increase. But important context here. This was heavily driven by recent acquisitions. There was organic growth too, but acquisitions were the primary driver.
Right. And this ties into their playbook you mentioned.
Absolutely. This segment really shows it. They buy businesses like Micropack or Keyoptic recently, knowing the initial margins might be lower.
Okay.
But then they integrate them, apply their processes, and focus on improving those margins over time.
And they seem pretty good at it. Wasn't there a stat about that?
Yeah, a fascinating one. They said they've taken acquisitions bought at, say, 9 times EBITDA.
Which is, a standard valuation metric.
Right. Earnings before interest, taxes, depreciation, amortization, and through margin improvement alone, those same businesses are now effectively valued at just 3.4 times EBITDA based on their current earnings.
Wow. That's serious value creation just from operational improvement.
It really is. It speaks volumes about their integration process.
Definitely. Okay, and finally, engineered systems.
Smaller segment, sales up 3.3%. But the profit jumped massively. Segment operating profit up over 60%.
60%? How?
They put it down to strong execution on government programs and just a favorable mix of projects during the quarter. Efficiency in action, basically.
Got it. Okay, so that's the segment breakdown. Now let's look ahead. Navigating the future. They sounded a bit cautious about Q3.
Yeah, they did.
Yeah.
They're forecasting Q3 sales to be essentially flat compared to this record Q2.
Which seems odd given the momentum, the strong book-to-bill. Is there weakness they're seeing?
Not exactly. They were very clear this caution isn't based on orders falling off a cliff in early July.
Okay.
It's more a concern, a management judgment call, that some of the Q2 strength, especially in those shorter cycle businesses.
Like the test and environmental stuff.
Right. That maybe some of that was demand pulled forward, customers perhaps ordering ahead of potential U.S. trade policy changes or tariffs.
Ah, okay. So it's proactive caution, not reactive.
Yeah.
Typical Teledyne, maybe.
Yeah.
Historically prudent.
Exactly. It fits their pattern. Better to underpromise and overdeliver, perhaps.
So how does this view and their recent spending affect their capital allocation plans? They spent quite a bit on acquisitions already this year.
They did. About $770 million year to date. But their balance sheet still looks very healthy. Debt to EBITDA is only 1.6 times.
Which is quite low, very manageable.
Very manageable. And they still have over $1 billion available on their credit lines. Plenty of firepower left.
But are they still looking for big deals? Or shifting focus?
This was interesting. They significantly increased their stock repurchase authorization up to $2 billion now.
Buying back their own shares. Why this shift?
They were pretty blunt about it. They talked about the insanity of prices or exorbitant valuations for larger potential acquisitions right now. Some deals going for 19 or 20 times EBITDA.
Oof, yeah, that's steep.
Very steep. So in that environment, they figure buying back their own stock might be a better use of capital, offering better value. It shows discipline, I think. They won't overpay just to do a deal.
Makes sense. Stick to your value criteria. Okay, let's talk growth frontiers. Unmanned systems and drones seem huge for them.
Absolutely. And they have deep roots here. You mentioned the history. They built thousands of Firebee target drones way back during the Vietnam War.
Incredible. I didn't realize it went back that far.
Yeah, it's not a new thing for them. Today, the portfolio includes things like the tiny Black Hornet reconnaissance drone.
Right.
But the key advantage, as we touched on earlier, is that they don't just make the drones. They're a huge supplier of the sensors, the EOIR, electro-optical infrared payloads that go into other companies' drones, too.
Right, the eyes and ears.
Exactly. So they benefit from the whole market growing, not just their own platform sales, and it helps their own sensor margins because of the scale. They also mentioned a new weaponized drone, the R1, is in development.
Okay, definitely a space to watch. What about this Golden Dome opportunity they mentioned? Sounds intriguing.
It does. It's an emerging area related to missile defense, specifically missile tracking from space.
Ah, okay. High priority stuff.
Very high priority. Teledyne's actively involved in the early stages, responding to requests for proposals. Their angle here is their strong position in space-based imaging and the electronic subsystems needed for these complex tracking systems.
So things like the Space Development Agency, satellite constellations, overhead persistence infrared, that kind of thing.
Precisely those kinds of programs. Their long history in space imaging, both for science and defense, gives them a really strong footing here. It's a natural fit.
Makes sense. Okay, last major point. Tariffs and taxes. Always a concern these days. How exposed is Teledyne?
On the sales side, they seem pretty well insulated. About 82% of their revenue is either U.S. to U.S. or international to international, skipping potential U.S. tariff issues on exports. Only about 2% of their exports actually go to China.
Okay, so not a huge direct sales hit from potential U.S.-China tariffs. What about the cost side? Imports.
That's where there's more exposure. They import around $700 million worth of materials annually. They estimated that tariffs could add maybe $60 million in costs even after they try to mitigate it.
That's not insignificant.
No, but their plan is apparently to offset that through price increases. They didn't seem overly concerned about demand destruction from those price hikes.
Interesting. And any impact from tax changes?
Yeah, a positive one, actually. Changes related to R&D tax treatment mean they expect to pay about $30 million less in cash taxes in the second half of the year.
Okay, so a nice little tailwind there on the cash flow front.
Exactly.
All right. So, recapping this deep dive, we've seen Teledyne post really impressive Q2 numbers. Record sales, record earnings.
Driven by that balanced mix of organic growth across all segments and successful integration of acquisitions.
Right. And we saw how their strategic focus on defense, unmanned systems, subsea tech, and critical sensors is really paying off in the current environment.
Yeah, hitting a lot of key growth areas, but also maintaining that characteristic caution in their outlook, managing expectations.
And that disciplined approach to capital, prioritizing buybacks when M&A valuations get too high.
Their whole approach seems very meticulous. It's not just about growing sales, but systematically improving margins, especially in the businesses they acquire. That focus on integration and profitability really stands out.
Definitely. And with that deep heritage in critical technologies like unmanned systems, like space-based sensing, they seem, really well positioned for the long haul.
Agreed. They've built a resilient, diversified portfolio in some very strategic sectors.
So maybe a final thought for you listening. We see this meticulous, often cautious approach from Teledyne, focusing on disciplined growth, margin improvement, careful capital allocation. In today's world, with all the rapid tech changes and global uncertainty, is that disciplined, maybe slightly conservative strategy the best path to sustainable long-term value? Or does it risk being too slow, missing out on the really bold, game-changing opportunities? Something to think about.